How does money work? There's an old saying that goes, money makes the world go round, but how true is that? Well, join us today on this enlightening journey as we unravel the secrets of the financial world and explore the profound wisdom behind that age-old proverb. With that said, let's get started. In contrast to common beliefs, the nature of money, especially in its physical form, has remained quite consistent throughout history. The earliest semblance of what we now recognize as a banknote can be traced back to China in 118 BCE when it took the form of a piece of leather. It wasn't until 900 years later that paper currency came into existence. It took several more centuries for this form of currency to reach Europe and eventually spread worldwide. Despite the passage of centuries, the fundamental concepts initiated by the Chinese are not significantly different from what we have today. The primary divergence lies in the underlying representation of these notes and coins. The first globally recognized system for valuing currency was the gold standard, which originated in England in the early 1800s. This system directly linked a currency's worth to the established value of gold. For instance, in the United States, $1 was equated to precisely 1 in 50 of an ounce of gold. Initially, this system aimed to establish stability in the global monetary landscape, and for a period, it achieved this goal. However, like all natural resources, the supply of gold turned out to be more variable than initially assumed. Consequently, countries began abandoning the gold standard as a measure of currency value. In 1971, U.S. President Richard Nixon officially severed the link between the U.S. dollar and gold. At that time, the U.S. dollar held the status of the world's standard currency. Thus, once the dollar's value was no longer tied to gold, it became essentially untethered. So, if the worth of a dollar is no longer determined by its connection to gold, what then confers a value of $1 to it? Instead of a commodity-backed system like the gold standard, we now rely on something known as fiat currency. This type of currency lacks inherent worth and is instead supported by the authority of a government. The value of today's dollar stems from the economic principles of supply and demand within the United States, overseen by governmental financial institutions. In the United States, the Treasury and the U.S. Mint are responsible for the production of currency. However, with the increasing prevalence of digital commerce and the replacement of cash registers with iPads, traditional money printing is becoming less relevant. So if governments are not physically printing money, how does cash enter circulation? The majority of money exists purely as digital figures within computer systems. Vast sums of money are digitally credited to commercial banks by the central bank of a nation. This central bank regulates the amount of money it injects into commercial banks based on the economic conditions of the country. During the early stages of the pandemic in the U.S., some money was directly deposited into bank accounts in the form of stimulus checks. Nevertheless, this is an exceptional circumstance, and most of the time, money doesn't reach us in this manner. Typically, the process involves a central bank channeling money to banks and credit unions across the nation, and they, in turn, disperse this money into the economy by lending it to their clients. This leads us to the subject of debt. Approximately 80% of Americans find themselves in some form of debt. However, many individuals lack a comprehensive understanding of what debt truly entails and how its various components function. What is commonly known, supported by numerous studies, is that even the prospect of repaying debt can exert considerable emotional pressure on individuals. Dealing with debt is a topic that no one particularly relishes. However, in a world where the cost of living consistently outpaces our income, loans become an unavoidable necessity for many. Loans serve as a means to buy a car, kickstart a small business, pursue higher education, or secure a place to call home. When it comes to owning a house, most of us don't have the funds readily available in our bank accounts. Nevertheless, having a roof over our heads is a basic requirement. Consequently, some opt for renting, while others choose to obtain a bank loan in the form of a mortgage. It's crucial to understand that banks are not charitable institutions. They exist to generate profit. Their primary avenue for doing so is through interest. Interest, in this context, represents the fee you, as the borrower, pay for using the money provided by a bank or financial institution. It's just like the monthly rent you pay for your apartment. You don't own the apartment, but you're granted its use in exchange for a fee. Similarly, you don't own the money you utilize to purchase your house, but you access it in exchange for a fee. This buy now, pay later model isn't limited to significant investments like a house or education. It has permeated all aspects of our society, especially with the advent of credit cards. If you don't have sufficient cash for that new couch, you can charge it to your credit card. Or probably you want to acquire the latest iPhone. All you need to do is agree to a monthly payment arrangement with your internet service provider. Surprisingly, even gaming consoles like the Xbox have adopted this model. In today's world, credit is used to cover even minor expenses like a quick meal, a new pair of pants, or pet supplies. If we promptly settle our balances for these purchases, we can sidestep the interest rates levied by credit card companies and remain financially stable. However, for many of us, particularly during challenging times, accumulating interest on our credit cards can quickly lead to precarious financial situations. While credit cards can provide a financial safety net when needed, they also come with an inherent element of risk. Which brings us to a question: is it worth it? Well, opinions on this matter vary, and it's a subject worth exploring. Some view frequent credit card usage as a pathway to accumulate burdensome debt, while others see it as an opportunity to establish a favorable credit history, a vital aspect of contemporary life, particularly when leasing apartments or purchasing vehicles. No matter what you think, everyone agrees that it's important to be careful when you use credit cards. If you spend too much, you can end up with more debt than you need. But if you're smart with your money, save some, and find ways to make more, you can have some extra money to start investing, which is a really important financial step to take. You see, investing essentially entails committing your money to ventures with the expectation of receiving a financial return. It's about putting your money to work for you. In the realm of investments, a common adage says, "The greater the risk, the greater the reward." For instance, investments like bonds are considered safer, but offer relatively lower returns. Conversely, investing in individual stocks can yield substantial returns but is associated with high levels of risk. And then there's the world of cryptocurrency, which opens up a whole different discussion. Exploring the intricacies of investing requires an extensive discussion, but the ultimate objective, if we have the opportunity, is to amass wealth, to increase our net worth. Money serves as a measure of value, indicating the worth of something or someone. Consequently, we as a society have become preoccupied with the notion of worth, spanning from material possessions to personal and even others' worth. Publications like Forbes and Bloomberg compile lists of wealthy individuals, assigning numerical values to their success. These lists are meticulously constructed by tracking down millionaires and billionaires globally, gathering their personal details, summing up their presumed assets, and deducting their liabilities. However, this seemingly straightforward addition and subtraction are deceptively challenging. Obtaining reliable data and discerning where affluent individuals store their wealth is no easy task. Many of the world's wealthiest individuals are involved in investment banking, yet the composition of their firms' portfolios, which directly influences their wealth, remains largely undisclosed. It's worth noting that most celebrities' net worth figures are essentially educated guesses and don't accurately depict their degree of control. Alright guys, that wraps up our video for today. If you enjoyed this video, don't forget to give it a thumbs up and hit that subscribe button to stay updated on our future content. If you have any questions or topics you'd like us to cover in future videos, please leave them in the comments below. Thank you for watching, and as always, stay financially savvy. See you in the next video.